Good morning, everybody. Happy Friday. I'm just getting everything set up. Thanks for joining us. Hope you've got your coffee. Here's my plug for my local coffee shop, um, the Wood and Whisk. No, I don't get any kickbacks if you do happen to shop there, but they do great coffee. So thanks for coming along. Today is our virtual coffee workshop. Looks like everybody's got their microphones muted, so that's great. Thank you very much. We'll take some questions at the end. Other housekeeping for those who haven't joined me before. Hope you've got your coffee or tea or preferred beverage. As I said, Friday morning kicker. The format is about half an hour. Take questions and answers at the end. Pretty full agenda today, as I always try to do, trying to pack in as much value and relevance for you as possible, but at the same time trying to appeal to as broader demographic and client base as possible. So without further ado, I'm going to launch the presentation. Let me just share the screen. What am I looking for? Here we go. Here's our agenda for today. So this is what's been going out on email, so shouldn't be any surprises. So we're going to have a quick look at economic and market backdrop and how that has impacted your portfolios in terms of returns, what's moving, what isn't. We're going to have a look at the proposed changes to capital gains tax. Any property investors are getting quite nervous about the proposals, so we're going to explore that briefly and maybe some ways to mitigate risks and some money and spending tips. Quite a few of my clients are looking at installing solar batteries, so just an article I thought might be useful for some guidance on that, and if we get some time, another great discount website that I found. So let's get started. First of all, economic update. This is taken from our head office quarterly review that they do. Normally we would do this in the last Friday of the following month. So a bit of a caveat because of the holiday and summer vacation, we do this quarter the following month. So some of this data is a little older than normal, but just still relevant. So overall, the year was good. The calendar year was good. Third year in a row. I'll show you some numbers that demonstrate that in terms of portfolio returns. What's been really interesting, and probably no surprise given the political situation in the US, is there's been what you call a rotation or a movement away from US-based investments elsewhere. And again, when I show you the numbers from the different investment sectors and asset classes, you'll see exactly how that's been playing out. The other thing as well, I think I've added this here, the capitals, that most countries' interest rate cuts are the order of the day, so to speak, with central banks. Not in Australia. Headline yesterday, inflation is again above target. They're now talking about a second rate rise in May, possibly a third one later in the year, I think October, November. So Australia's the outlier at the moment on the inflation front. How does that affect investment markets? Well, yeah, it all depends. How long is a piece of string? I think in general, owning equities or shares or stocks, whatever you want to call it, is generally a good thing because plenty of companies, particularly in Australia, where you've got quite a lot of oligopolistic markets, a couple of big players, supermarkets is a great example, notwithstanding they're being investigated by the ACCC. Banks, another good example, where you own businesses through the strategies we're employing for you, through the funds that you own and the managers and the exposure. If they can increase prices greater than inflation, then that's a really good hedge. So broadly speaking, everybody we work with has at least, in most cases, half their money in assets that can grow with inflation and keep up with inflation. That's the whole point, right? So I don't think it's necessarily a panic. If you have a lot of debt and you're a floating rate mortgage holder, then that's a challenge from that standpoint. So yeah, that's the main divergence between Australia and globally with the rate outlook. When you look at the currency as well, that's impacting, the Aussie dollar starting to get stronger again against its main trading partners. There's good and bad in that. Briefly speaking, on the economic front, again, US is the standout in terms of economic growth and just in pure numbers, so over 4% for their annualized GDP. So it's still chugging along very strongly, particularly compared to other major regions. And inflation's under control, right? Hence, we've been saying they're actually cutting rates in the US. Europe is mired in sort of long-term structural challenges. They can't compete with China manufacturing sector. In fact, Germany this week, the chancellor, I believe, was in China, pitching their their plea for Chinese companies to go easy, or not exactly the right language, but the takeaway is that European manufacturers are being hurt by, they can't compete. Think about things like electric cars, but yeah, it's there's still some amazing companies and businesses, etc., in Europe and the UK. Really, just an observation of what's happening. When I say structural challenges, they have an aging population, low rates of population growth, like Japan as well, another major economy. So these are long-term things that aren't easily fixed. Speaking of Japan, again, lower growth. Political stability improved. So as of a couple of weeks ago, the PM was re-elected by a very, very strong margin, but she's quite pro, spending, fiscal expansion, those kind of things. So I'd be nervous if I was a Japanese bondholder, because generally government spending more money is bad if you're a holder of bonds, because the government's going to issue more of those, which means the ones you own are going to get devalued. China's chugging along at sort of its long-term growth rate. There's Australia. So yes, we're about half the US in terms of growth, not necessarily a direct short-term correlation with returns from shares. We'll look at that in a sec. Again, sound like a broken record, but housing prices are chugging higher apart from Northern Territory. I can think of a couple of clients I've been working with in recent months that are, looking around sort of the low $1 million, just under $1 million price point to first home buyers to get into something in Sydney. Obviously, nowhere in the inner ring, but and there's the comment I got the other day was the prices have gone up about 50,000 from when they started looking. One couple that I can think of, which is tough for them to hear that. Market and asset class performance. Again, emerging markets, really good year. We're going to look at the numbers in a sec. So just a bit of commentary there, but yeah, we'll dig a bit deeper into that shortly. So that's the economic backdrop. Let me find the returns page. Let me zoom this. I'm just going to have a chug of coffee. So hopefully this table is looking very familiar. The top one is the returns over different time periods from all the main building blocks of your portfolios. Every single investor in the world pretty much has the same shopping aisles, if you will, investment opportunities. You could add another column here called alternative assets. We're not big advocates of alternative assets, partly because they're very hard as an individual investor to own. So an example would be a hedge fund, which is a sort of, or private equity, fairly complex, opaque, hard to price, not very transparent with what they're worth. So for all intent and purpose, this is the standard set of opportunities for the vast majority of you and me, the people in the world. And so that's why it's good to look at what's been happening under the hood, so to speak, of the different sectors. And each of your portfolios consists of allocation to each of these sectors for the most part. And you add up the parts or the sum of the parts of the returns from the different parts of your portfolio, and you get a portfolio performance, which we'll look at in a sec. So the 5-year numbers, as we are happy to see, the right-hand side here, property shares, global shares, emerging markets, if we just pick a 5-year number, all positive, right? Which is great. The whole point of being here and investing and growing our wealth is exactly that. You want to see over time positive returns. That's why we're here. Even 10 years, the same thing as well. A green line, pretty good returns, but reasonably big divergence in the last 5 years, between say Aussie shares and global. Interesting, in the last 12 months, that's flipped around, right? Aussie's actually done a bit better. So just to refresh your memory, this guide here is the benchmark. So the main index or measurement that we use, that commentators use, which is the ASX 200, largest 200 shares in Australia by value. The combination of how much price has moved in the 12 months to January 31, and also the dividends on top of that. So dividends would have been about 4.5%, 5%. So that means you had a little bit of capital growth in those the basket of those 200 shares. But yeah, still pretty healthy numbers to look at. But what's more important, how that translates into returns from your portfolios, because you don't have 100% of your money in one of these particular investment areas. That would be extremely risky, and we'd be going against everything we believe in terms of diversification. The best way to get a guide is if we look at the Vanguard products. Why? Because they are very large, liquid, transparent, low cost, reliable, safe in terms of, safe in terms of transparency. You still have to take some risk to make money. But in terms of a guide as to what's happening, they're a great place to start. I've picked the growth index funds. This is a basket of all the main global assets. So this one here that we looked at in different proportions, but broadly speaking, around about 70% in stocks of some form, and around about 30% in cash and bonds of some form. And that's the asset allocation there, or their target. So roughly a third or 20, 30% in Aussie shares, global shares here, hedged and unhedged, exactly a third, etc. So it's a good proxy for what's been happening in most of your portfolios, unless you have a very unusual or unorthodox allocation or targets or mix. So if we just have a look at how things have been tracking with the returns, and we're going to go to a table, and we're going to look at to the end of January. So yeah, so this is sort of a sum of the parts of what's been happening in the underlying. If you own a portfolio like this, most of our clients own somewhere between a 50 and an 80% exposure to shares. So it's a good proxy. The Vanguard fund's done about 8% to the end of January. So still very healthy numbers. The 5-year returns are just under 8%. The 10-year returns are just over 8.5%. So at 7% a year, you're doubling your money every 10 years. So, between 5 and 10 years, had you started this back then, that would have been the result. Another way to look at the information is a chart, a plot point of every quarter, or every month rather, of if you started with $10,000 5 years ago and reinvested the income, the dividends and the interest, etc., from the different investments in the portfolio. This is how the value would have increased over time. And what you can see is we are almost at peak value. So the value of most portfolios would have peaked late last October. You can see here this hypothetical. Let me zoom a bit, make it a bit bigger. Whoops. Where did we go? There. 14,681. Right now we're at 14,650. So almost at peak highs, lifetime highs, which correlates with the commentary we were talking about before, right? Most share markets are at or near all-time highs, and it's the share markets and the growth assets, mainly stocks of some form, that are what is driving your portfolio growth. That's why you're there. That's why we're in it. That's why we're here. Also, I just want to show you the yearly results, because this gives you a feel for how often you can expect or you would have experienced a negative return. So we've had 3 good years in a row, right? If you see here, the third column, the annually, calendar year. Okay, so these numbers are a bit different because we're looking at to the end of 2025. Nice, clean concept in terms of how the calendar year's been doing in a 70-30 portfolio. And you can see all double digits the last 3 years. The last down year was 2022. That was when there was a huge spike in interest rates as we came out of lockdown, the supply chain issues, bond market sell-offs, share market sell-off, quite an ugly, unusual year. So every 3 or 4 years, you can see here 2018, there was a small loss as well for a typical, for a 70-30 portfolio. So every 3 or 4 years, there's generally a down year. It doesn't mean that you should abandon the strategy, but again, part of our role is to mentally prepare for those things and make sure that we've got, if we need to take money out from your portfolios, these are the years to do it, which is exactly what we've been doing for our clients who are taking money out, either for retirement or investing, buying a house, helping kids, whatever that might be. So that's the overview. Another great year. Overall markets are still, near or at lifetime highs. The divergence I wanted to mention here was, we talked about global share rotation. So this number here, this global shares return of 15% or 6.5% the last 12 months in January. Underlying that is money moving out of the US, because the global shares covers every market. The US represents about 65% by value. This is a great illustration. Emerging markets, which is everywhere in the world other than sort of the big 15 or 20 economies. So China's the main one in that index. Also Brazil, India, it was Russia, but they're obviously benched at the moment for their terrible behavior. Massive difference, right? So there's huge money or some money sweeping across to emerging markets. Where we can, for most of you, we've introduced some exposure to this about 3 or 4 years ago. So that's been good timing, if for nothing, for no other reason, a diversifier. So that's an example of the rotation, right? Money, investors selling US-based assets and moving across to, say, Europe or emerging markets. And so if you broke this down into sub-indexes of different regions, you'd actually see that that's what's happening. We don't have a crystal ball. Again, we're all about spreading your money around all these main asset classes in a way that's appropriate for your needs, age, stage, how much risk you want to take, your drawing needs in the next few years, etc. So yeah, it's been a great calendar year. Good start to this year, broadly speaking. Unless you have all your money in tech stocks or AI exposed stocks, which if I'm doing my job, none of you do. So let's have a look at the CGT changes. And this obviously, the caveat with this stuff is that it is all speculation at this point. There will be lots of scuttlebutt in the next couple of months as we approach the May budget, which is very typical of governments because they want to test things. They want to have just tactical or strategic leaks of information and so on and so forth. So the caveat in what I'm presenting is, I know as much as what you read in the press. And so it's just a little bit of guesswork and speculation, but still important to understand, because if you do own a property, an investment property, or looking at one, just because of the absolute value of those properties, a change in a CGT rate can have a pretty big impact, as you'd expect. But there's definitely plenty of momentum at the moment. So I guess the takeaway is that it sounds like something in some form is going to happen. The opposition doesn't have much. They're too busy fighting amongst themselves at the moment to really form a formidable defence. I haven't looked closely at their policy. Obviously, they've only just had leadership change the last week or two, and they're betting that down. But yeah, the language the Treasurer is using is intergenerational inequality. So it's an easy target. It's a nice soundbite. The way we got to this situation was prior to 1985, there was no CGT. And then from 85 until the introduction of the GST in the year 2000, there was a form of indexation, right? So basically, in plain English, you'd only be taxed on the increase in value that wasn't because of inflation. So it was a reasonably complex calculation. There was like these, index numbers that you'd use and apply, and you'd get there in the end. And so with the last major tax reform, it was just simplified. It's like, let's just give everybody a flat 50% discount on the tax rate, their marginal tax rate, if the assets sell for 12 months or more, whatever that is, property, shares, any kind of investment asset. And that's it. That's been the way of the land for the last 25 odd years. What are some of the noise and proposals? Reducing the discount from 50 to 25%. I read this yesterday, so this is the Treasury option. The government, can but doesn't have to take guidance from the Treasury. I suppose, like anybody, they'll take guidance if it suits them, and if not, they'll ignore it. But yeah, so as I said, it sounds like something is going to happen. They're currently saying it won't be retrospective, so a bit like the 1985 rollout of cap gains. If you owned assets to that date, they were grandfathered, right? So if you eventually sold them, there was no capital gains. I don't know. This could change. Obviously, if you're a property investor, you're hoping that it isn't retrospective. In other words, everything's taxable. There's no grandfathering or date from which the new rules start. That's what that means. Yeah, interestingly, they're saying that Treasury is saying if you only focus on housing, in other words, if you own shares, you still get the discount when you make money and sell. Then it's not going to raise a lot of revenue. If you expanded that to everything, their estimate is it'd be 5 billion of revenue. So watch this space. To me, it seems to be lopsided to tax one and not the other. That'll change the behavior as well. It'll probably obviously you'd expect push more money into shares. How does that look financially? So this is, let me zoom in a bit. If you cut the CGT, and this is an if, right? Again, just running with what's in the press. The idea is it's the high taxpayers they're targeting, A, because they're easier targets, and B, because the government would raise more money. The current highest tax rate for an individual is 47%, right, including Medicare. So there's a table here. This one down the bottom here, right? If you earn over 190,000. So if you own $1 million investment property and you bought it for 500,000, and let's say it's in Sydney or one of their capitals, and you sold it for $1 million, and you've held it more than 12 months. It's a gross gain of 500,000. It's a net gain of 250,000. You can see pretty quickly, and if you're already working and a decent earner, you can see pretty quickly you're going to be pushed straight into the top tax bracket. So effectively, what would happen is that the effective tax rate on those gains with the discount would go from 23.5% to 36% almost. What would happen then? Well, obviously, and that's part of my job, in any legal, legitimate way possible, is to working with good tax accountants as well, is, can you restructure? Can I own and hold assets in different entities? So like every tax change the government rolls out, they'll have these estimates, but then there'll be leakage, right? People will change their behavior. Okay, I can own shares and still get the discount, but I don't get that anymore with property. Well, yeah, there we go. That's an easy decision. I'm going to invest in shares instead, as a simple example. So what are the options? What do we have in our toolkit? You may have seen this before. This is sort of a simplistic planning tool we use, particularly with new clients or clients that are looking to restructure or have come into some windfalls, a significant change in their circumstances. And this is the tax ladder. And the idea is, when we're structuring for clients, is that there's, broadly speaking, 5 rungs on the ladder or tax structures in Australia for the vast majority of us out there. Individual ownership, jointly owned if you're in a relationship, a family trust, an investment company, and superannuation, or running your own super fund. And the idea is we want to be stepping down the ladder, because as you move down, in general, the tax rates become lower. And so, as an example, if we picked step number 5, as we've just said, the maximum tax rate could be 47%. The effective tax rate there's not much difference really. You don't have a lot of flexibility, but it's the easiest to manage. In terms of, that's it. Whatever you own and you sell or buy, it sits in your personal name. If you look at something like number 3, right, a family trust, the maximum tax rate can be 47% if you don't distribute the money. But often the effective tax rate can be anywhere from 20 to 35%, but it's more complicated. So, and you have to run a separate entity, do tax returns, make sure the money's distributed. Too much detail to go into much more on this presentation, but and a lot of the pros and cons about these structures depends on your particular situation. So, a family trust, may be an option to hold assets, but a lot of it depends on, can you send the money, the income from the asset in that trust, to lower tax beneficiaries, right? And so there's quite a few rules around that. There are some sweet spots in when and how to use them with certain clients on our books, and their family situation. Again, happy to take a one-on-one call if anybody's curious. You've got rung number 2, which is an investment company, Investco. The maximum tax rate is 30%, right? So if you're, and the effective tax rate can sometimes be, high 20s, let's just say 25% when you're structuring things appropriately, make sure you're loading the relevant expenses in there, so on and so forth. It's a little more straightforward, but still a separate entity in terms of pros and cons. So you'd have to run, accounting and tax for it. But the benefit here, I guess, is you're never going to be taxed at more than 30%. So as I said, if we look at here, if you're already on a high tax bracket and you know that any future taxes on your property investing is going to be 36, then maybe people are going to start looking at, investment companies instead. And that's what we said here, right? Companies or insurance bond. An insurance bond is a similar kind of thing, maximum tax rate of 30%. However, the traps with these kind of, investment company, that should say, with these kind of structures is things like land tax. Depending on what state you're in, you don't get any land tax exemption, no exemption or no threshold, etc. So again, I'm just trying to do shorthand here to illustrate. And then last but not least is ladder number 1, or rung number 1, which is super. And the maximum tax rate is 15%, but can often be 0, depending on your age and stage. But it is complex as well. Rules are changing all the time, etc. There's limits on how much you can have in super. That's always under attack. So, I guess the idea is, depending on your individual situation, we want to try to bring you down the ladder, but it's all going to depend on what you're using at the moment, what the family situation is. My personal view is the investment companies are probably pretty safe from, or a corporate entity, are pretty safe from any further legislative attack. You might have heard from time to time Labor and the Greens saying we want a minimum rate of tax of 30% no matter what structure. So they've talked in the past about family trusts being taxed at a minimum of 30%. That seems to be the line in the sand. So this isn't, again, necessarily anything to act on right now because we don't know the detail. But these are the entities where, if you can, you want to try to own or hold assets if it's possible. So happy to take individual calls on that. That's the CGT side of things. We're running right on 11 o'clock. Trying to stick to my promise. We might just have a quick look at the other 2 things. This is an article. Happy to send it to anybody if you are looking to install or upgrade your battery storage for your solar. It's been well publicised, but there's a government rebate that's going from 2025 to 2030. Each year it ratchets down in terms of the benefit. Depending on the kilowatt hours that you buy, the rebates, sort of scale, but broadly speaking, it's about a 30% rebate on the cost. So 10 grand battery set might be 7 grand after the rebate. I'm not an expert on this stuff. We don't have solar ourselves because we live in an apartment, but I've had, clients looking at it. So the things to watch out are, sort of dodgy claims. Make sure you do your homework and independent verification. Like anything you buy, I would say, wherever possible, not just solar batteries, storage batteries. If it's too good to be too good to be true, make sure, again, you do the homework, independent research. If they're inexperienced, if they're new, like things like if it's a new ABN, pushy sales tactics, high pressure. They don't sound like they know what they're talking about, or they don't give you clear information. Go with the well-known brands or installers. Likewise, if you can't get the details about the actual technical bits, that's also a red flag. If there's no after-sales support, I think that's really important as well. Where is their help desk, right? Are you talking to a bot? Are you talking to a human? Are they in the Philippines? With all due respect to call centers, everyone, they do their best, but there's cultural differences. So that's the battery rebate scheme to watch out for in terms of tips if you are looking. Last but not least, Macquarie have a great transaction account. Again, this is not a plug for Macquarie. We just use it as a family. A lot of our clients will use Macquarie products as well. Why? Because they're good, they're competitive, both on fees and rates for the most part. There's occasional exceptions, and again, money, independent financial consumer research magazine, who I've been a subscriber of for a very long time, as have some of my clients, have awarded this account 3 years in a row, the Money Awards, as you can see. The reason I'm mentioning it today is not necessarily for another bank account, but what we discovered, and hat tip to my beautiful wife, Ali, who's also our client service manager, Monday to Wednesdays. We also found out that you can purchase, once you have an account, you can actually purchase gift cards. And here is, I had to do a screenshot because it logged me out after inactivity. So apologies if it's a bit small. But if you open an account, a transaction account, so I also have a CMA, right? But this is a transaction account. That's the difference. This is just a sample of some of the gift cards that you can purchase. I've circled ones we use a lot. We like to travel. Obviously, we need groceries, so 3.5% off Coles. It doesn't sound like much, but as a family, as I said to you many times before, we probably spend at least $10,000 a year on groceries. So that's $350 if we use a gift card every time to do so. Amazon, right? Who isn't using Amazon? 3%, again, doesn't sound like much, but it compounds. So to me, this is a free lunch. So yeah, if you have an account and you log in, you can see I'm logged in here, and then you just there'll be a rewards tab here, and you can look at all the cards. The key difference with this scheme versus other ones I've talked about in the past is there are zero transaction costs. So I've talked about NRMA Blue, Entertainment Book, Cash Rewards is a different scheme, so park that one. But so if you're getting a 3.5% discount off Coles, but you've then got to pay, or purchasing the card, then you've got to pay a credit card fee of 1.5%. It's like, okay, why bother? But with the Macquarie, what we like about it is, it's just, as long as you've got money in your account, it's instant. It pops up on your Macquarie app. So yeah, if you are a big user of discount cards, and there's more cards here, I've just done a sample. I'd recommend having a look. And you wouldn't have all your money in the transaction account. I think the rate's 2.25%. So, just a final plug for that. As I said, no incentives. We just like the the flexibility of how easy it is to get the cards. Excuse me. So, apologies if I talked a bit fast on that last bit. Also, want to talk about a book giveaway. Again, if anybody would like to post a Google review about today's workshop or any of the work we've done for you in the past, as a thank you, we would love to send you one of these 2 books. You get to choose your own adventure. I've actually had the benefit of or the privilege of interviewing Noel Whitaker last year. So there's a video on our website of me chatting to him about retirement planning. This guy is an absolute legend. And Tony Robbins needs no introduction. So yeah, both great books. If anybody's interested, love it if you posted a Google review. That's how clients find us, or one of the ways is reading reviews, word of mouth, etc. And if anybody wants to book a call, you can go to our website, or obviously drop me an email as well, but you can book a free call here and just pick a time that suits you for me to call you back for anything you want to chat about. As always, just remember, this is general advice only. Best of my knowledge based on the current tax and super rules, so on and so forth. Book a call, drop me an email, whatever's easy if you want to explore things further. before I finish up, are there any questions? Anybody want to unmute? And I'll give that 15, 20 seconds or so. Or in the chat box. I can check the chat box as well if someone would rather message.
I just want to say that I have installed solar at my place.
Okay.
I had solar already, but now I have installed a battery.
Yep.
And I'm quite happy.
Great.
And I recommend changing your energy provider to Amber.
Amber. Okay.
Yeah, the way they work is that they pass you on all of their whatever Energex or whichever company is providing the electricity in your area, whatever they charge, Amber passes it on to you so that you get cheaper prices.
Mm-hmm.
And all they're taking is $25 a month.
Okay.
Plus,
that's awesome.
Plus, on their app, you can see exactly what is going on. And they have something called Smart Shift, whereby when they realize that the price is currently high, they will automatically, if you have the setting put up right, they will automatically sell to the grid when the grid is paying you the most.
Awesome. Wow. I can see, yeah, it looks pretty good, Daniel. Thank you.
It's worth
Thank you very
looking at
much.
that.
And you have no affiliation with the company, correct? Full disclosure?
No, not at all, except that I'm a
No.
customer.
That's a happy customer. That's great.
A happy customer.
Like my business, right? You got to spread the word when they're doing good work. So thank you very much. Thanks, Daniel. Thanks, folks, for watching. Have a great weekend and see you next quarter. And as I said, book a call if you want to chat on anything that resonated with you today. Thanks for watching.